One of my favorite books is All Work and No Pay by a monetary realist, Dr. Paul Hein, a St. Louis area ophthalmologist, now retired, who is willing to talk with me and answer my slow man questions. This is David Tulis. I am really the slow man of Chattanooga. I just don't catch things. I don't see how things work like they're supposed to. And when it comes to an official narrative of how the economy is going or how America's healing its own wounds and so on, I'm just asking the awkward Burr-like questions about the future and about the law. You know, what is the law that's allowing this to happen? What are officials minding their obligations to the people or to the Constitution? Where do we go from here? Seeing how far we have strayed from the constraints of lawful government in this country. Dr. Hein, we're hearing a lot in the past few days about Grandma Yellen, the Federal Reserve System, and that private bank. I think you maybe can tell us a little bit about the Fed. That private bank has $4 trillion in assets. Now, these are called assets. I'm not quite sure how that happened, but maybe you can tell my listener and me how it is that the central bank is richer than it was before, because in 2007 and 8, before the meltdown, it had only about $1 trillion in assets. So how's it gotten richer in the collapse? What's the story there? And why is Grandma Yellen now talking about unwinding these monetary tools, as they're called, in Washington? What's the story, Dr. Hein?
Well, I haven't caught the latest thing from Mrs. Yellen about unwinding, David, but I know that the idea of bankruptcy and debt are confusing nowadays, because there is no money. There is only debt. I mean, if our debt were eliminated, we'd all be penniless. The dollar bill is a note. That is a promise to pay money. A check is an order for the bank to pay money, but what money? And all of the money is borrowed, and it is borrowed because the banks create money every time they make a loan. So if you go and borrow $1 million from the bank and you give them your IOU for $1 million, that's an asset of the bank. So debts are considered assets in this crazy upside-down world of ours. So the more debt we have in the country, the greater the assets of the banks who are holding those notes. Now, how can you go bankrupt if you can create money? I think a federal publication, maybe Modern Money Mechanics, states that there is a greater danger of inflation than bankruptcy, since bankruptcy is technically impossible for an institution that can create money. But when the money supply increases so much, that a loaf of bread costs $1 million, then the whole thing collapses. It's just too preposterous to continue. And that's happened a number of times in history. And I suppose it's possible for it to happen again, although the people managing the Fed are certainly very bright, and they've managed to hold it off so far.
Well, what is the reason that the Fed feels somehow it has to now soak back up the excess credit that it generated starting in 2008? It from going, its ledgers were $1 trillion in so-called assets now to more than $4 trillion. And that, as I understand it, the creation of this asset on the bank's ledger is really somehow more credit in the market. Is that right? Is that what's been happening since the collapse? More dollar units circulating in the global economy from the Fed's work?
I think, from what I've heard and read, that most of the so-called money that the Fed created with this qualitative easing business has stayed in the banks. It hasn't worked its way into the general circulation as much as they thought it would, which has led them to have another episode of quantitative easing, but it doesn't seem to be working. The banks are holding on to it, and I noticed that some of the banks are purchasing hundreds of millions of dollars worth of gold, which might be a clue that they realize something is wrong and that we're in danger of runaway inflation if they keep this up.
Are you suggesting, Dr. Hein, monetary realist and author of All Work and No Pay, one of my favorite books, are you suggesting that the system can't really unwind, it really can't contract? Because if there's a movement toward contraction, it really will be unstoppable. Is that what's happening in Japan? There's been, I think, a deflation there that's lasted 15 years or more, where the system of the yen paper money's base is declining, and they can't get it to expand.
I think, yeah, you're hitting the nail right on the head there, because if the banks intend to try and stop this process of creating more money, disaster looms, because currently the government and private individuals are trying to borrow themselves out of debt. The greater the amount of money, the greater the amount of debt, since all money is created as a debt. And so to pay that off, more money has to be created to pay the interest, because the interest wasn't created, only the principal. And the thing just snowballs and snowballs and snowballs. And to try to stop it, to stop creating money, for example, is going to mean complete collapse of the economy. The original monetary realist in St. Louis suggested that one way out of the problem, which is never going to happen, of course, is that the Fed be compelled by the government to buy back all of the assets it obtained with its money creation, and they would take their money back and in return release the goods that they've obtained by creating it. And once they have received the money back again, it would have to be created or annihilated. That would probably be a less painful way of getting out of the problem, but that's not likely to happen.
When a debt is repaid, is it fair to say that the dollars that were represented by the debt are annihilated? Your use of that word prompts that question. When a debt is paid, it's annihilated.
That's the theory, yes, that if you borrow $1 million from the bank, that your note, which is an asset of the bank, is reduced every time you make a payment until that money is annihilated. But you still have the $1 million in your account to spend. So it's kind of dubious as to whether money annihilation can take place without the real cooperation of the Fed. And I don't think they would want to do that.
I checked the price of silver this morning, Dr. Hein, in my money changer email. I'm told by Franklin Sanders in Middle Tennessee that a bag of $1,000 costs about his bid price is $12,187. How is it that a bag of $1,000 costs $12,000? What's the difference in the dollars that we're talking about?
Yeah, that's a great question. If you ask simple questions like that, I wrote Mrs. Yellen and about 5 or 6 Congress people asking simple questions like that, you won't get an answer. I mean, how can $1 cost $10 or $50? It's meaningless if there's no definition of the word dollar. You're simply floating around in space. You don't know what you're doing. It seems to me that I've come to the conclusion, after writing many people and asking simple questions, that the simple basic questions are not going to be answered. If you would ask the IRS, for example, how do you calculate the tax that's due on money that you won gambling in Estonia or something, they can give you an answer to that. But if you write and ask them, how can you swear to the value of your income in dollars when neither income nor dollar is defined, they will ignore you, or possibly they'll say you're taking a frivolous position and subject to a $5,000 fine. So without definition of terms like dollar, there's no other term of measurement like that. The pound isn't, one thing one day and one thing the next. When you put gasoline in your car, the number of gallons that you put in is carefully determined by the Bureau of Weights and Measures, so the gallon is a bona fide gallon. But dollar? No. Of course, it suits people who create money that we accept as money to have no definition of the dollar. That way they can't be held to debasing the dollar, since there's no definition of it anyway. It's all basically, I think, very dishonest.
Well, the term dollar is a reference, well, historically it comes from the German Thaler, which was a reference to a certain coin of silver, a certain fineness and a certain weight. So the word dollar is a term that defines some characteristics of measurement in silver, and that would be in terms of weight of the coin and the fineness of the silver in that coin. So a dollar should be understood as a fixed set of numbers in weights, whether troy ounce or ounce or grams, right? It is a term of measurement.
The Coinage Act of, I think, 1792 defined a dollar as 412.5 grains of standard, that is to say 90% pure silver. And that definition, I suppose, is still on the books somewhere. The law at one time said that for debasing the dollar, the penalty was death. Obviously, nobody's paying any attention to that, and nobody's paying any attention to the definition of the dollar. But you're right, there is that definition, and it only makes sense that the dollar have some defined quantity, since, for instance, you're signing contracts to pay dollars in the future or to receive dollars in the future, and you're entitled to know what you're talking about. But if you try to get a definition of the dollar Well, I asked the IRS one time the definition of a dollar, and they simply said there is no definition. So it's anybody's guess. Probably a good idea, therefore, not to store too much of your wealth in dollars.
And yet, the economy cannot operate without effectively the Federal Reserve dollar, the digital version, or the paper version. More and more dollars, of course, are digital. They're funneled through the credit card industry, which has a credit tax, you might say a tapeworm tax on the transaction of 15% or more per annum, or maybe it's per month, but it's a large amount of money. And so dollars are, you're telling my listener, Dr. Paul Hein, dollars are created artificially. They're created sort of ex nihilo from nothing. And my listener and I, we have to work for our dollars. We have to earn them. But that one unique shining sector of the economy can make them from nothing by extending credit.
Yes. The axiom, there's no such thing as a free lunch, always annoys me when I hear that, because there certainly is. If you can pay for your lunch with an IOU that you offer to the restaurateur that you have no intention of redeeming, then you have gotten your lunch for nothing. And that's what the bankers can do. They can create money out of thin air and collect interest. The interest is just as imaginary as the money, but they can buy things with it. And it costs them nothing to get those dollars. They create them with the push of a button or the stroke of a pen. So the old axiom, no such thing as a free lunch, simply isn't true. It applies to you and me, but it doesn't apply to the bankers.
What do you recommend, Dr. Hein, for my listener who wants to preserve and store his value in some kind of instrument? Is gold a good thing to have, or at least to think about, or silver? And why is there a reason in principle, as opposed to just in terms of investment advice? Why is there a reason in terms of principle to have some stake in lawful coin, Dr. Hein?
If you're a family man, for example, you have an obligation to your family to look after them. You may have accumulated, a lot of dollars in your bank account, but even if the government doesn't seize those to try and solve its economic problems, which is always being talked about, you have an obligation to look after them, to provide them with some sort of insurance. Now, you can buy insurance from an insurance company, but if things get really bad, is the insurance company going to be able to pay off what it owes your family? So having something tangible, something that will always be valuable and doesn't depend upon the stroke of a pen or psychology, gold and silver being perfect examples, I think it is obligatory for someone who has a responsibility to others, for example, and to himself, to get rid of money, which is ephemeral, and get some real tangible wealth. Money isn't wealth. Money is just a claim. But gold and silver and other things are wealth.
So claim versus wealth. This is David Tulis. We're talking with Paul Hein, who's the author of one of my favorite books. It's called All Work and No Pay. Ordinarily, I have Dr. Hein on the first Friday of the month, which is Cash Friday, but I thought I would not call him and not declare Cash Friday, because I had the sense in my press wanderings that the system would not be able to withstand you're my listener and my withdrawing $100 in a bill from their counters. I was thinking maybe that we didn't want to cause them too much trouble, so the withdrawal of $100 from me and from you, the listener, might cause some alarm in that system. Dr. Hein, I guess the point I'm making by explaining why we didn't have Cash Friday this month is this: is the system liquid or is it illiquid? The banking system.
Oh well, tough question. Probably illiquid. You see, as an organization that creates money, excuse me, it's hard to think of it as illiquid, but it also has to have a balance sheet. And if you withdraw your money, the balance sheet gets a little bit out of kilter. For example, if a person has borrowed a lot and is unable to repay, then his IOU becomes worthless, and the bank's assets, because the borrower's IOUs are the bank's assets, then the bank's assets diminish. It's simply a notation on an account. I mean, it's numbers in a ledger, but that's the way the things work. And so a bank can be illiquid if its borrowers are unable to pay the debt, and I think increasingly that's happening.
A depositor is a lender to the bank. Is that right, Dr. Hein?
Yeah, I guess you could look at it that way because, as I say, the bank considers its assets to be the IOUs of the borrowers.
And therefore the deposit is a liability, and it's a liability because the deposit has to be paid back to the depositor. So
yes.
And so the depositor is the lender, right? That the deposit is effectively a debt the bank has and an obligation to pay the depositor back when the depositor demands it.
I'm sorry, go ahead.
Well, okay, I was going to ask about my listener. My listener has an aunt on the other side of town, wealthy woman. She'd speculated in the stock market, and pulled in $1 million in her great work prior to 2008. She lost half her value in the meltdown of her shares going down, but now it's all back. She's worth $1 million again. She's got a $100,000 CD that's due. Let's just say, due on the 1st of November. Now, the question I want to ask you this: if she takes a $100,000 CD and says, "I'd like to have cash for that," what is the effect on the bank if it has to cough up cash for that former digital version of dollars, 100,000 being the number in question, Dr. Hein?
Well, I guess it depends on the size of the bank, but taking cash in that amount from the bank is going to be maybe a serious problem for the bank because cash is so-called hard money. I think there's a term for it. Whatever the bank has in the way of cash, it can use as the basis for creating 10 times as much money to loan. So if she has $100,000 in cash in the bank and takes it out, the bank may be unable to loan or unable to support, say, $10,000 in loans and may have to call in some of those loans. So withdrawing significant amounts of cash from the bank can present a real problem for it.
And the injury to that company, or the alarm that the banking company has, is that the smaller its reserve requirement, the more damaging a cash withdrawal is. So $100,000 deposit, a CD that matures, withdrawal of that into cash could be worth millions, right? Depending if that reserve, if that bank's reserve is 2% or 3%. I mean, you're mentioning 10%. I think 10% or 12%. That was the old reserve fractional reserve limit, but I think in some banks it's down to 1 or 2% or even less. I think some small banks have no reserve requirement at all.
Yeah, I think you're right. I think for some savings accounts there is no reserve requirement, whatever, which is a very scary situation.
And why is it scary?
A woman who has $1 million in the stock market and a CD worth $100,000, in my opinion, should certainly do some serious thinking about getting rid of some of those imaginary dollars and getting something real and tangible instead. And certainly gold and silver are preeminent in that idea.
Well, one argument I make, Dr. Hein, to my listener is that he should divest nationally and invest locally. So that means that he should invest in knowledge. He should invest in local businesses. He should invest in skills and perhaps himself or his own business. That way, your dollars are converted into human beings, or converted into stores or local service companies, and you're less vulnerable to depreciation by having those dollars converted into a local business or assets such as gold and silver, or maybe even land.
Yes. Yeah, I think land is tricky because you can't move it, and it's very visible, and it's recorded and taxed. So real estate has never struck me as being a particularly good investment, but then I'm frankly too lazy to deal with all of the complications of owning and maintaining and buying real estate. But if you can buy wealth privately, that may be increasingly difficult to do. I haven't tried it lately, but that would be preferable. It's not that you have anything that you are ashamed of, but you don't want to make yourself a target either. So buying wealth privately, off the record, so to speak, seems to me to be a very good idea.
Well, we live in a country where we have inflation, and the rate of inflation, Dr. Hein, is said to be below the target. The Fed wants to have a 2% target, and it just somehow, despite ginning up cheap credit for years now, it just can't seem to get past that. The listener, I think, as he reads Marty Krutzinger's AP stories in the local newspaper and other mainstream media accounts, he thinks, wow, 2%. Oh, poor bank, it can't reach a level of 2%. That's really what we need to have for the sake of the country, our economy. Well, when we hear in press reports about growth in the economy, is there a secret meaning of that word growth? Is it, what does that mean? What we think it, what they want us to think it means, or does it mean something else, Dr. Hein?
I think when you listen to any statistics, economic statistics put out by the government, you should be very, very skeptical. And the idea that a 2% growth rate, 2% inflation rate is acceptable is crazy. Inflation is a form of theft or robbery. Every dollar that you have is losing value by, say, 2% every year. Be desirable is beyond me. So a desirable rate of inflation is an oxymoron. That's just absurd. And as far inflation rates and economic information like unemployment figures, I wouldn't believe them for a minute. I think the government lies to its teeth when they're talking about such things.
So inflation probably is higher than the reported rate of under 2%, Dr. Hein. That's what you're suggesting.
Absolutely. I'm convinced it must be.
So my listeners' dollar holdings, all the holdings denominated in dollars, are losing their buying power at more than 2% per year. I've seen estimates anywhere from 8 to 15%, Dr. Hein, of the actual rate of inflation. That it's hard, in a way, it's hard to measure, and it doesn't show up necessarily in food or gasoline costs.
Yeah, the rate of inflation depends upon what the government is picking for its basket full of commodities that it uses to calculate the cost of living and so on. And it changes those contents from time to time as it suits it. So more proof that you shouldn't take anything seriously that you hear from the government about the inflation.
I think the problem with Federal Reserve money, Dr. Hein, is that it's private money. And what the Constitution requires is public money. Is that a distinction that would be helpful to mention? What do you make of that distinction, Dr. Hein? Private money versus public money. I would say we want public money, not private money.
Well, what do you mean exactly by public money?
Well, public money is money that's self-enforcing. That would be silver coins like the ones I'm clanking in my hands. This sound here, that's silver. That's public money because it doesn't rely on any private party to guarantee the value. It's publicly guaranteed by the actual weight of the coin, meeting constitutional rule for fineness and weight of silver, Dr. Hein.
Yes. Well, in that case, yes, public money, if that's what you mean by the term, and that's agreeable with me, is certainly preferable. You don't want to have money that depends upon its existence by definition by the government. Money existed long before there were governments. People used all kinds of substances for money before they had any elected representatives or unelected representatives, or for that matter, before there were any bankers. So public money, meaning wealth that people can barter with among themselves, certainly is preferable to any money that you have to take because the law says you have to take it.
Right, and that's a reference there, Dr. Hein, to legal tender laws, which are perhaps the greatest oppression that we have as a country financially. Legal tender requiring us to take depreciated paper in payments of debt, tender of payments of debt.
Yes, yes. Well, the legal tender laws don't exactly force you to take it, but on the other hand, if you decline to take it, there's nothing else that you have to be offered. In other words, you're offered something that is, by law, legal.
Dr. Hein, thanks for joining us. Appreciate it very much.
Oh, you're welcome.
This is David Tulis talking with Dr. Paul Hein, author of one of my favorite books, All Work and No Pay. Have a great weekend. David Tulis, Nooganomics.com.
Traffic, news, and information. Nooga Radio. Digital FM 95.3 HD.